Thank you. I note from Mick Keogh's address earlier today that agriculture is the most risky sector of the Australian economy, cropping is the most risky sector of agriculture, and that crop production is more risky in Australia than anywhere else in the world. But also note that he was talking largely about production risk, which is much greater than price risk. And I do actually wonder if why we are showing up these days as having a high degree of production risk is maybe because Australian farmers have had huge productivity gains, which has resulted in increased water use efficiency that is making our output very sensitive to growing season rainfall. So we may have brought this production risk on ourselves, or this perceived production risk. Okay, I need to talk about the price risk side of it, which is not quite as big as the production risk, and how deregulation has affected that, and how growers can operate in the deregulated market. Deregulation of the grain markets have left growers exposed to new risks. At the same time, deregulation has opened up new opportunities, and there are marketing tools that can be used to help market grain in ways differently to what we're used to under a regulated market. Pre-harvest risks in the grain markets have not changed much, but the risks post-harvest have increased, and yet growers have moved decisively in this direction with no apparent sign that they have collectively understood the risks they are taking. The wheat price structure in Australia is driven by US futures as a surrogate of global wheat prices, Chicago Board of Trade basically, exchange rates and the basis against those US futures. The correlation between year-on-year moves in the $8 value of US futures and grower returns is extremely high. This indicates that neither the regulated nor the deregulated systems have provided growers with much risk management in terms of changes in wheat price from one year to the next. The last time this risk was managed for growers, in fact, was in the late 1980s under the guaranteed minimum price scheme of the then wheat stabilisation legislation. So since then, growers have been responsible for managing their own pre-harvest risk if they so wish. The correlation between the year-on-year move in wheat prices, which is effectively pool returns under regulation, and the year-on-year move in CBOT futures from 1 November to the next is close to 96%. However, it is possible that that relationship is weakening under deregulation, primarily because of more variability in basis levels from one harvest to the next. So let's talk about that basis risk for a while. It is the one risk that has increased for wheat growers with deregulation. Deregulating the wheat market in Australia should have had minimal effect on US futures, minimal impact on the Australian dollar, so if there are going to be any changes at all, it was always going to come via the basis component of the price. It is in fact what has happened, and it has changed the risk profile faced by growers. Not only is the basis part of the price changing more from year to year than it did under regulation, it is also more prone to changing during the year, coming under more pressure during harvest in particular. When we compare against CBOT futures at harvest time, so we're comparing prices against CBOT futures at harvest, the regulated market delivered the basis via the final pool return. Under regulation, the harvest cash market has delivered harvest basis levels in 2 years out of 4 that were lower in all years since 1994, and the highest harvest basis we have ever had. So growers who now sell for cash during harvest have moved from delivering to the having moved from delivering to AWB pool under regulation, have harvest basis levels that have been more variable from year to year than we ever had with the regulated market. So let's look first at that harvest price risk. If we happen to end up with lower basis levels during harvest, and also US futures falling at the same time, growers can be confronted with quite low prices during peak harvest. Even if US futures do spike during harvest, cash prices often do not follow, and so basis levels weaken as a result. The temptation against low prices and low basis levels is to hold grain over for post-harvest sale. Then you get to the post-harvest sale, post-harvest market period, and basis levels may well rise. But if the futures component or currency are moving in the other direction, very little has been gained. One of the features of the cash market since deregulation is that while daily cash prices can be quite closely correlated to daily moves in Chicago adjusted for currency, that correlation has been dropping away during the harvest period. At one stage, I think in the first year of deregulation, the correlation dropped to 18%, having been around about 95% leading into harvest. It may then take until March, and we still haven't seen it this year, may even take longer for the correlation to return. In the meantime, if we have a very poor correlation, what we find is that basis levels can move quite dramatically during harvest. So what can growers do? Growers are always trying to get a better price, and one way of doing it is to build a better price and to lock in favourable futures prices when they appear during harvest, without locking in the poor basis. And to do that, we are finding that more growers are starting to price their grain during the harvest or in the post-harvest period with swaps rather than selling the direct physical in the first instance. Quite simply, on days when futures rally and the cash prices also rise but not as much, so in other words basis levels fall, some growers are selling swaps rather than the physical grain. Then later on, so they actually lock in the underlying currency and futures, and they just sit there waiting for basis levels to return or to improve. When they do, and they buy those swaps back, and the grain is sold to deliver a higher return by the amount that basis levels have lifted. Often basis levels lift simply because futures have fallen, so that the final price booked by the grower is higher than the price back during harvest because the basis levels have gone up, but also much higher than the price being achieved by growers who simply chose to hold their grain for sale in that post-harvest period. So that's the difference between hedging and unhedging to get into that post-harvest period. The latest harvest is an example, but it's happened in just about every harvest, or in every harvest we have had since deregulation, that growers are able to build a better price for their wheat by selling July swaps. This year there were opportunities in early January, rather than selling the physical wheat. In the Clear Grain Exchange that we also operate in our company in Melbourne, there was quite a spike in the sale of physical wheat at a time when basis levels were really quite poor. Once you've sold a swap, as long as the basis levels improve, it is possible to capture a better price than the price foregone at the time of entering the transaction. So for example, on January the 3rd this year, just after the new year, the cash market had lifted to $214 per tonne at Port Adelaide. The harvest low on December the 12th had been $202 a tonne, so it's no wonder a number of growers pulled the trigger. But basis levels were at minus $18, having fallen from about minus $5 in mid-December. The alternative was to sell the July swap at $250 a tonne. When I checked the figures earlier this week on March the 2nd, you could buy that swap back for $235, clipping a profit of $15 a tonne. And part of that was because the cash price was still at $213 a tonne, but basis levels had lifted from minus 18 to minus 12. On top of that, the $250 swap price captured in January was actually factoring more than normal carry charges, adding to the final price that's possible. So far the price being achieved is $9 per tonne over the harvest cash price foregone, even after accounting for holding costs. Compared to growers who have just held their wheat until early March, the gains are $15 per tonne. Further gains can be expected if basis levels improve further, which may well happen as we go into the middle of the year and global wheat prices come under pressure, and as our exporters continue to seek grain for bulk shipment for mid-year shipments. So that's just one example of how growers are actually managing the price risk on their grain, but at the same time using the system or the tools available to improve their returns. Pre-harvest selling and basis. So let's look at the forward market. After 2007, forward selling earned a bad name, but the reality is that forward pricing has delivered better prices in 11 of the last 16 years, and if you do it correctly, has added an average $18 per tonne to final returns. Many growers are continuing to hit income targets by forward pricing wheat. Now, some of these numbers are relatively modest, of course, but if you start looking at the profit margin on growing wheat, it is a substantial percentage of the profit we are talking about.